Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Geoff Yu of BNY in writing, investors are navigating a market that feels both familiar and fundamentally different. Growth is uneven, but still has room to run. Geoff joins us now for more. Geoff, good morning. Happy New Year. Wonderful to see you. I want to start with something that you said in your latest report, which is sometimes it's better to ask good questions than to have answers right now. What are the key questions you're looking at heading into this year?
I think from clients' point of view, the questions are, sustainability. As you've said, we've had 3 good years of double-digit returns. Can we extend that to a 4th? And overall, it's if I am concerned about valuations and the like, and there is going to be a bit more of a volatile path, what are some of the defensive positions? How do I diversify? I think those are one of the questions as a responsible investor. You stay the course. If it ain't broke, don't fix it. But you need to know where some of the pitfalls are. Look at them in advance and identify the insurance plays. So I think that comprehensive approach is going to be the key question as we asset allocate heading into 2026.
Geoff, one of the key questions about diversification is what are you diversifying against? Is it inflation risk or is it the risk of recession? Because the potential diversifiers are completely different depending on that answer.
I totally agree with you, and I think it's different diversifiers for different markets and also in different regions. If I look at the run of European data that we've had this morning, I'm afraid it's looking a bit more stagflationary. So if we're going to worry about inflation and worry about a stagflation environment, I would probably worry more about Europe than the US for this year. If I look at APAC, for example, Asian bourses are doing quite well. So there's a bit of a tech run there too. So can that actually take place, but not at the expense of my tech positioning in the US and elsewhere, and how do I defend against further trade volatility up ahead? So I think all of these aspects are important, but look at it on an individual market basis, rather than you think that there's one insurance play that can defend against everything. I don't think that works anymore.
What about the broadening out, Geoff, that we've heard so much about? There have been a lot of head fakes. We finished the year with all of the high bandwidth DRAM makers winning the S&P 500, Western Digital, SanDisk, Seagate, all the biggest winners in terms of the individual stocks. And then Robinhood, Newmont, Lam Research, Palantir. Those are exactly the same stocks that are up today in the pre-market. Are we going to see a broadening out, or is it just going to be the same, top 20 stocks pushing this rally into 26?
I think that goes to a broader question about the broader economy. So, can that K-shaped growth that we're seeing, not just in the US, but I think other economies can sympathize as well, can that actually narrow a bit so that K sort of converges, the 2 arms of the K, into more balanced growth? And here's where we get a multiplier effect into the broader economy. So can Main Street benefit as well? If I look at our underlying positioning data, yes, tech has done well, but consumer-related segments have really softened, and that points to a margin story. That points to a demand story as well. So can we have that the so-called trickle down effect into Main Street? If that can happen, then we can see a broadening out from the tech stocks, which are overheld, of course, heading into 2026, but into some of the consumer-oriented stocks as well in the US and also in EM. I think that is a consensus view for the year. Asset allocation into EM tech, but for China, for Japan, and for the rest, can we see EM consumer stocks do well? Are we going to see a fiscal push benefit consumers? So globally, it really is about Main Street. If Main Street can pick up, then we'll see that broadening out. But I think on the fiscal side, markets are waiting to be convinced.
Here in the U.S., of course, everybody in markets wants to see, or everybody, I guess, long stocks wants to see Fed cuts. Is that going to continue? And will that help Main Street, Geoff? Is that going to be able to bring down mortgage rates and auto loan rates, which so far haven't responded very well to 175 basis points of cuts?
So I think the question is, as the Fed cuts rates, and I think that is going to be a consensus view, of course, your cash flow improves on the liability side. What Main Street wants to see, not just in the US, but around the world, can real incomes grow? And if it can grow, can expectations pick up? You look at the UK, for example, as Governor Bailey has highlighted, wage growth is very strong, but you're seeing savings rates go up as well. It looks like the UK is going to run a double-digit savings rate on a sustained basis, which is unheard of, right? So what is it that's holding back the consumer in the US, in the UK and elsewhere, and also in APAC? They're sitting on high savings, but they're not spending. They're not pushing it into the broader economy. So I think that requires more stability in terms of their expectations. Yes, wage growth is firm right now. Can that be maintained? And the US economy, this no fire, no hire economy, let's move into a more hiring economy. I think that's what's needed to get Main Street going and to lift the consumer segment.
Right now, the consensus is that the dollar will weaken, even if you do have stronger growth than, say, in Europe. And it's because of the rate cuts that are expected. What do you think is going to be the main driver for the currency? The actual growth rate or the expected rate cuts by the Federal Reserve, with the rest of the central banks around the world largely sitting on their hands?
So I think it is going to be policy differentials at the end of the day. So as long as we go through this so-called hawkish cut approach with the Fed, I think dollar downside is going to be a bit more limited. Yes, there will be hedging, and the cost of hedging will factor into that, as rate differentials shift around. But if I look at APAC, right, APAC FX is where we see the most capacity for strength against the dollar. It's not going to be in Europe. I've been wrong on euro dollar last year, so this year I still think euro's looking a bit stagflationary, so I think euro strength is going to be capped, but dollar weakness against the likes of the renminbi, against the likes of the yen, that is the consensus view. But I'd be a bit more cautious there too. Yes, APAC currencies will rally in real terms, but in nominal terms, I'd be a bit more careful. If China, for example, can shift PPI from negative 2.2%, 2.5%, that's the values right now, towards positive 2, positive 3, that kind of real effective exchange rate appreciation is something that they would probably be more happy with. So position for your dollar very, very carefully. If there's going to be dollar weakness, I'd probably see it more against APAC rather than European currencies.
Speaking of China and sort of U.S. versus China dynamics, Xi Jinping over in China had this New Year's message that he gave in an address. China has become one of the world's fastest rising economies in terms of innovative capacity, giving a nod to the war in terms of AI prowess between U.S. and China. Do you have a sense of who is going to come out ahead at the end of 2026?
So I think the direction for innovation and AI, if we look at it, the application, for example, is a bit divergent. So I think both can lead in terms of one is consumer facing in the US side. On the industrial side, that's what China's focusing on. But what investors, what the positioning is looking at is, can we see AI prowess in China and also beyond translate into higher margins, higher earnings growth, and that can lift the consumer. That seems to be the missing link in asset allocation right now. But having said that, a lot of savings are being pushed into AI stocks in APAC. We've seen the IPOs, the reaction over the last 24 hours of trading also. Hence, that theme is going to play out in the different fields, of course. But again, can that translate into growth into Main Street earnings and wages and lift Chinese consumer spending as well? That will require not just on the corporate side, but on the fiscal side. I think that's going to be one of the big pushes for EM growth this year, and will have positive benefits for the rest of the world as well. If you look at Europe, for example, it wants to see stronger Chinese demand. That trade deficit certainly needs narrowing.
Stay with us. More Bloomberg surveillance coming up after this.
Dana Peterson of the Conference Board writing, 2025 is ending on a confusing note for markets, economists, and central bankers alike. So we should not completely ignore the data. Dana joins us now. Happy New Year. Thank you so much for being with us. Dana, let's start with the data that we have gotten. Why is it so noisy? How should people look at it, considering that people do view it as somewhat noisy, but also they can't ignore it?
Exactly. You can't ignore these data. We did have data for the third quarter. Certainly the GDP came in a lot stronger than expected. And certainly consumption was a lot stronger, even though we did have data. It shows that the Federal Reserve, it shows that the federal government probably had more data in between releases and certainly after the shutdown. But I think the key thing is that inventories and trade were very confusing. And indeed, when you add up the inventories, when you add up the imports plus the consumption, the inventories numbers just don't make sense. So we really need to get data next week on inventories as well as international trade, business sentiment, and also employment. I think we really need to see more data to get a handle on what happened in the third quarter and also what happened in the fourth quarter.
Dana, we are going to get some data come next week that is going to be important, including the non-farm payrolls as well as some of the manufacturing aspects that you're talking about. Nonetheless, we have a host of other information out there that people keep pointing to, whether it's ADP, whether it's earnings, whether it's the rhetoric coming out of a lot of companies, or whether it's retail sales. I mean, is there some sort of conclusion that you can take even amid the noise?
Well, I think, certainly the stock market does not reflect the real economy. So we can't look to that. And also most people don't own stocks, so they're not really benefiting from that. We do have lots of sentiment data. Of course, our consumer sentiment data has shown that consumers are less sanguine about the current conditions, as well as having some concerns about the future. Retail sales, all we have really is the end of the third quarter, and they were weaker. So I think that we just need more information, and you can't look at these things and try to estimate what the government data is going to tell us.
I'm looking at the Conference Board Consumer Confidence Index, and it hasn't been this low since the pandemic. So what does that tell us about, inflation, growth, spending?
Well, I think the inflation bit has yet to hit us. Remember, the tariffs that were implemented were delayed twice, and also they were raised and lowered several times. So many businesses are still waiting to see if there's any certainty with respect to tariffs. Yes, we've had a number of deals established, but there's still a lot that's unknown. And so with businesses uncertain, it just means that we're not going to see much hiring. We're not seeing layoffs, which is good. Most people still are working, but those who do get laid off are finding it very difficult to find jobs. And even though most consumers are working and they actually are spending, the type of spending that they're engaged with is very different. They're buying things that they need. And when it comes to, especially with goods and services, and when it does come to things that are entertaining, they're buying cheap things, right? Cheap thrills like streaming instead of going to the movies and paying, over $100 for a family of four. And so I think we need to really get beyond the first quarter of this year to really see what's happening, because I think that's when we're going to see the bigger effects of tariffs on inflation and consumers really pull back.
Dana, I've been trying to pin down how workers' wages have kept up with inflation. As I've been saying, Torsten Slok put out a 6-year average showing that wages are doing better than inflation. But Mark Chandler, whom we just spoke with from Bandenbrook, says in his household, that certainly isn't the case, and he doesn't think that it looks like a great picture for consumers. How do you see it?
Well, yes, wage growth and compensation have been slowing from the peaks that we saw during the pandemic, certainly the later portion of the pandemic, when we were trying to get everybody back into the labor market, and you need to entice them and also keep workers with compensation. But still, I would say that wages are still growing at a pace that's above where we were between the great financial crisis and the pandemic. But I would look at the last GDP data where we saw real disposable income grow at 0.0 percentage points annualized in the third quarter. That's not a good sign. And so we definitely do see slowing in wages. And for some people, it may be faster than others.
Stay with us. More Bloomberg surveillance coming up after this.
Under surveillance this morning, locked and loaded. President Trump saying the U.S. is ready to rescue Iranian protesters if they are attacked by authorities. Protests escalating over the country's deepening economic crisis. Andrew Bishop of Signum Global joins us now for more. Andrew, what do you make of this locked and loaded comment? Do you think that there actually are plans in place to intervene by the U.S. in Iran?
So I don't think the plan is to intervene. I think this should be read mainly as attempting to give the protesters a chance, right? So to essentially tell the regime there should be a red line not to cross, and that is, quote unquote, violently kill. I think it is interesting and a bit gruesome, but interesting the way that the president chose his words, that essentially supposes that if they are killed, but perhaps not shot out during protests, but instead arrested and, disappeared, that would be a little less sort of crossing the president's red lines. Also potentially shot at with rubber bullets. We know that in previous protests, the regime used that to blind protesters. These are gruesome details, but I think that they actually should be read in the context of the president's choice of words.
So what would we do with people if we save them there? Does that mean we'd bring them here as refugees?
No. I think what would happen if the president were to intervene in the conflict is that the U.S. would essentially target the security apparatus. So we would essentially launch, to put it very simply, Tomahawk missiles on IRGC domestic facilities, especially besieged sort of the more hardcore security forces meant to keep control of the situation. We would essentially attack those and hope that the protesters can then have a chance at overwhelming the regime's security apparatus.
I thought it was interesting that, we've been chasing this oil tanker, Bella 1, which came out of Iran, went to Venezuela, and is now headed, I guess, to Russia. The Russians have claimed this tanker. And it looks like maybe we'll give them a little leeway because it's Russia. At the same time, we're sanctioning Chinese and Hong Kong based tankers. Are we giving Russia a little bit more leeway because we want to get a truce or an end to this conflict in Ukraine?
Yes, but I would say the bigger difference between Russia and China is the fact that the U.S. Really doesn't have the ability to put any pressure on China at all. So we sort of are in the kabuki dance phase with China, where we pretend to impose sanctions, but they don't actually bite. So I think that's the biggest difference.
So what will we do? President Trump started this trade war with China. In his first term, President Biden actually carried it on in a sense, but now it looks like the Chinese have realized that their access and refining capabilities with rare earth minerals gives them a massive advantage. Is there anything we can do?
Not in the short term. I think in the short term, the U.S. And this administration have come to realize that there really is nothing that the U.S. can do to minimize China's overwhelming leverage over the U.S. And that's why we're seeing the president take such a soft, dovish approach to China. Yes, he's a deal maker, but some of the deals that he struck over the past few months with China are borderline humiliating, I think, from an apolitical standpoint, right? This famous sort of high-end chips in exchange for soybeans. It's pretty much from a bipartisan perspective. I think it's fair to say that's not a great deal for the U.S. And that's just a recognition of the U.S.'s weaker hand in the short term.
How much is this the reason why China is doing these drills around Taiwan right now?
So it is and it isn't. China would probably be conducting these drills. It's conducted drills like these every year, sometimes twice a year for the past several years. So in that sense, it's not particularly surprising. I don't think it's necessarily a result of the president's sort of soft approach to China. What's interesting or what's maybe more political is China's takeaways from the president's reaction to the drills, right? I think the State Department's press release yesterday that sort of condemned the drills and took a harsher tone was an attempt to not send the wrong message to China. But the president's decision to essentially say, President Xi Jinping hasn't talked to me about this, it's not a big deal. That is the kind of thing that Xi writes down, and potentially, let's be very clear about it, potentially factors into his decision to attack Taiwan for good at some point.
So there's sort of a panoply of potential risks geopolitically that people are looking at for next year. On one hand, you've got the China-Taiwan issue. On the other hand, you've got Russia-Ukraine. You, of course, also have Iran, as we were just talking about. And then you have Venezuela that has also been increasingly ground zero for a proxy between the U.S. and China, with China getting increasingly influential in South America. Which of those do you think is going to be the most significant heading into this year?
So on the question of likelihood, it's Venezuela, because there is a real chance for the U.S. to essentially ensure that Maduro is no longer in power, whether that's, kinetic action, CIA covert ops, et cetera. One can debate or even striking a deal with him. But let's put it like this. I think the odds of Maduro being out of power at the end of the year are well above 50%. And that's not something that can be said about the Iran situation or about an end to the war in Ukraine and so on and so forth, just because those situations are far more complicated, right? So in Iran, for example, these protests have legs, but to really go from this to actually toppling the regime, it requires a lot of steps. The security forces have to defect. They then have to take over the hardliners and win and so on and so forth. That's much harder than just essentially taking out Maduro. So from a likelihood perspective, I would say Maduro. From an impact perspective, it would definitely be Iran. I mean, Iran, turning into a different regime would have massive regional implications.
Stay with us. More Bloomberg surveillance coming up after this.
Wedbush out with its top AI stocks for 2026. Dan Ives writing, heading into 2026, investors are both excited and nervous about the AI revolution. 2026 is an inflection point year. Dan joins us now with his colorful self. Happy New Year. Wonderful to see you.
As always.
So let's talk about that. Why is it an inflection point? What do you mean by that?
It's really about, to me, it's about the second, third, fourth derivatives playing out across AI. Look, it's monetization. And you talk about Tesla, it's the next phase in terms of autonomous, robotics, consumer AI, especially when it comes to Apple, and I think what we're going to see. Look, I think it's a prove it year, but that actually makes me more bullish because I think now we go into the next phase of AI. I think tech stocks are up 20-25% in 2026, but it's not just big tech, it's about second, third, fourth derivatives playing out.
I will be fascinated to see. I don't think anything is officially expected, but you're going to CES, right, which is not only the biggest tech conference in the world, but has become the most important car maker conference as well. It'll be fascinating to see if Tesla comes out with any other products there, or if we see a lot more robotics and automation products.
Yeah, and to your point, look, it all starts with the godfather of AI, Jensen. He'll be there with the black leather jacket, because when his speech, to me, is just so important on Monday, because it really starts off strategically what AI is going to look like. He's going to talk about physical AI in terms of autonomous robotics. I think the two best physical AI plays in the world today, it's NVIDIA and it's Tesla. And I think that speaks to, you talk about like Tesla, what everyone's focused on. This is autonomous chapter now coming to Tesla. I think you see Musk right now, wartime CEO. That's the focus when it comes to AI, but also it's the monetization. Remember, only 3% of U.S. companies have gone down the AI path so far.
Are these robots expected to be like B2B robots, so building things in factories, or like a Roomba for consumers? What kind of products do you expect them to monetize?
Yeah, especially at CES. Look, humanoid robotics is going to be front and center. Autonomous. You're seeing flying cars. A lot of the presence. You talk about a lot of the tensions between U.S. and China. The presence of Chinese companies is going to be. It's going to be a monster in terms of what we see there. I think doubling, over the last few years. But I think it's really going to be about humanoid robotics. It's going to be about autonomous, but this is also going to be about more embedded AI devices that consumers are going to see. CES, we're not just talking about flying drones and refrigerators that talk to you. Now these are much more sort of front and center in terms of it's a who's who. Every big tech player is going to be there, even if they're not unofficially there. They're there to look for acquisition.
I love the idea of opening the refrigerator and having it say, "Do you really want that?" I mean, I can just imagine the future for, move over Ozempic. So there's this question here also about what some of the moves in late 2025 mean. And I'd love your take on this, because we saw some acquisitions made by the likes of Meta and NVIDIA. And I just wonder whether there's more cost consciousness and more of a competitive advantage that they're looking to solidify at a time where suddenly companies are saying, hold on, what are we paying for this and what are we actually getting?
Look, I think you hit on a great point, because the reality is it's an arms race. That's what's going on with big tech. And right now, at the top of that mountain is big tech. And when you look at like Google's win versus DOJ, antitrust, I mean, this is sort of go time for big tech. And I think you're going to see more and more acquisitions. And we've talked about not just on enterprise, on energy, and I think really across the board. And it speaks to really what we're seeing right here is that it's not just about big tech getting bigger and bigger, doing acquisitions, spending. You're going to have $600 billion in CapEx in big tech, but it's also you're going to see other players being like, don't forget about me. Look at AMD. you're going to see, like, look at Cisco, look at IBM. I mean, there's going to be a lot of other players saying, like, hey, we want to get into that AI party. We don't want to look through the windows, like a lot of the bears are.
We were talking about BYD triumphed over Tesla to become the world's biggest electric vehicle manufacturer. We also have seen big tech in China outperform on an equity market perspective in 2025. Do you expect that to continue and for China to really solidify more of its neck-and-neck position with the U.S. or even supersede it?
Look, I think the reality is for the first time in 30 years, the U.S. is ahead of China when it comes to tech. And I think that's very important, obviously led by NVIDIA, Microsoft, Palantir, and others. But in China, look, we're bullish on China tech. We talk about Alibaba, you look at Tencent, you look at a lot of the other names there. I think what you're seeing is it's a narrowing, but it's something where you're seeing robotics really play front and center, autonomous, EVs, BYD, and others in China. But when you think about how to play it, you have to play U.S. tech, and then there are Chinese tech players to go after. But in terms of AI revolution, like we said, it's third inning, one out, relative to this AI game. And I think the bears, like I said, like in hibernation mode, they can see AI in the spreadsheets. And I think 2026 is going to be a year that's going to be another bull market year for tech and for AI.
I had really the same question as Lisa, again, because we've seen so many stories this morning about Baidu's chip unit filing for an IPO, another chip designer, I think Breiner, with a very successful IPO today, maybe another mini DeepSeek moment, right, with a cheaper artificial intelligence, all among the most read stories on the Bloomberg terminal. So clients are paying attention to what's going on in China with AI. How do you bet on that? I mean, do you buy the individual stocks? Is there an ETF that you like? Do you have some of these stocks in your ETF?
Yeah, sure. So obviously, for the Ives ETF, I mean, what we really focus on is the AI 30. It's like, who are the 30 winners? We have a few of the Chinese players in there. I think Baidu, you look at Huawei in terms of the success they're having. Look, right now, NVIDIA's 4 to 5 years ahead of any other chip player. And I think that's well known. That's why even a third-rate H200 restricted, China big tech's going to line up despite what the politics in Beijing. But this is an arms race. It's the narrowing of the gap. You want to play some of those Chinese tech players, but the reality is in the U.S., from NVIDIA, AMD, we talk about our top five, Palantir, CrowdStrike, and cybersecurity. Tesla, I think it's going to be the most important year ever for them. Microsoft, I think on hyperscale right now, Microsoft, Oracle, those are names, I think, table pounders, in my opinion, in terms of what we see. And then Apple, finally, they come to the AI party instead of being on the treadmill at 2.0 speed. And now they actually start to get in terms of the consumer AI revolution, $75 to $100 per share.
There's only one company that you didn't mention that's on your list, and that's Microsoft. Where is Microsoft in terms of winning out versus Google? Who is its main competitor?
Look, in terms of Redmond, the enterprise, this is their backyard. When you think about companies that are moving to AI, the first phone call goes to Nadella. And I think you're seeing Google, you're seeing Amazon, what Jassie's doing, they're narrowing the gap and they're going to be successful. But when I look at Microsoft, you have 25, 30 billion incremental monetization. I don't even think it's factored into street numbers. That's right, in the stock ultimately has a 6 in front of it. And I think this is going to be, we're going to go into January, into earnings season. I think that's going to be kind of the show me story, showing like, look, this is not stopping. Like we said, AI party started at 9 p.m. It's now 10:30, 10:45 p.m.
Me and Lisa are asleep.
Yeah, 100%. That's exactly what I was thinking.
But the party goes to 4 a.m. And that's where we are.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.